Hey everybody, Nate Joom with Coast to Coast Lending. I am the leader of the Nate Joom mortgage team, and I'm going to take a little bit of time today to go through a few different things, explain to you what a mortgage looks like, walk you through the steps of a mortgage process, talk about different loan programs that are available, talk about different steps along the way of the pre-approval process, and then also help you understand what the difference is between a pre-qualification and a pre-approval. So we will go ahead and who is Nate Joom? Well, I want to introduce myself to you. I'm a third generation real estate professional. I grew up in the real estate industry. My grandparents owned a real estate brokerage. Of their children, we've had more than one that has become a real estate broker as well. So I literally grew up going on listing appointments with my grandparents, hanging around with my aunts and uncles. Like, I understand real estate to the point where most people that are in the mortgage business don't. Does that make me an expert in real estate? Absolutely not. But I work with some of the best real estate agents in all of Brevard County. And I am a former state certified mortgage trainer. I used to train the Florida Statute 494, which is the financial regulation for the state of Florida for mortgage lending. So I've got a little bit of experience in that as well. The Nate Joom team gives back to our heroes. I just want to highlight this real quick. So it requires no participation from the realtor or from the buyer. We waive nearly $1,700 in lender fees, and it can be used on any of the loan programs, whether conventional, USDA, FHA, or a VA loan. And it's available for active retired military, EMT, fire, police, nurses, physician assistants, ER doctors, and primary school faculty and staff as well. So getting into the meat of what I wanted to talk about today, what exactly is a mortgage? And a mortgage, for simple definition, it's where you're getting a loan to help pay for part of the home that you are getting ready to move into. So the mortgage company owns the home, you make payments to the mortgage company. Even if you have enough cash to buy it outright, a lot of savvy investors opt to still put some money down, but then get a mortgage for most of it because they can use the money that they have in other outlets. And I work with a lot of financial advisors and so forth that can help you learn to grow your money. There's two parts to the mortgage process. There's the part that's the contact to contract, which is where we're talking with you, we're gathering your loan documents, we're reviewing your loan documents, and we're deciding which loan program is best for you. And then the second part of that is going to be the contract to close. So that's after you've gotten into a contract and now you're working with a realtor and they're helping you try to find the right home for you. They're advocating and negotiating for you. You get that contract in, and then we work with you to make sure that we get everything together for you to be able to get into that home painlessly, effortlessly, and we have a lot of fun doing that. So what happens during mortgage processing? Well, this is just 5 of the points along the way. If you will, imagine that there's 1.2, 1.3, 1.4 all the way through, and vice versa for the 2s, 3s, and 4s. It starts with getting the application in, and then your loan moves into processing. After the processor gathers all of the documents from you and makes sure that everything is there and it's a complete loan package, he or she will pass it on to underwriting. The underwriter will look through your loan to make sure that you meet all of the criteria to be eligible for the loan. They'll make sure that you have the income, that you have the assets, that you have the credit score, that it makes sense. From there, they'll get it approved and cleared to close. Clear to close means that you don't have to do anything else. It means that we've done our job, you've done your job, the real estate company's done their job, and now we're just waiting on the title or settlement company to get everything together for the final day when we fund the loan. So in a nutshell, that's the 5 steps. But keep in mind, there's a lot of pieces in between that I didn't highlight here. We can talk about those if you have any questions. Here's some of the mortgage loan programs that we offer through American Pacific Mortgage. Coast to Coast Lending is a branch of American Pacific Mortgage. We offer FHA loans, USDA loans, VA loans, and conventional loans. Each of these different loan programs has some highlights and possible lowlights depending on what you qualify for and what you're interested in. An FHA loan is a popular choice because they have low down payments and the credit score requirements are also a little bit lower. You have a minimum down payment of 3.5% with an FHA loan, and for us, our minimum credit score is 580 on that particular product. Now, I want to talk to you, we're going to double back to it here in a few minutes, about something that's called mortgage insurance. Mortgage insurance is any time that you're putting less than 20% loan to value. And loan to value is calculated by looking at the purchase price less the amount that you're financing. So that difference there is your loan to value. So if you have an 80% loan to value, or if you've put 20% down, that means that you no longer have to have mortgage insurance. If you've put less than 20% down, you will. So we'll dive into that here in just a moment. USDA loans offer 100% financing. You don't have a down payment. You also don't have mortgage insurance with a USDA loan. But you have to be in an area and an address specifically that is approved by the USDA. So we have a website that we can go to, that you can go to. It's a public website where you can check that address and see the eligibility for that particular property. A conventional loan, that's what most people refer to as a regular mortgage. That's a standard mortgage. That is not backed or guaranteed by the federal government. They are conventional conforming loans. Conforming meaning that it conforms to the Fannie Mae and Freddie Mac guidelines. You may have heard that term before. Freddie Mac, Fannie Mae, they buy all of the conventional loans in the United States. You have mortgage insurance with that. Your minimum down payment with a conventional loan could be as little as 3% in some cases. In other cases, you might have a 5% down payment. Okay, and then finally, VA loans, and that's what I primarily work on, is VA loans. VA loans are for those that are active duty or retired military members that meet the eligibility requirements. There's no down payment, and in some cases, depending on how you were discharged from the service, you might also have the ability not to pay the VA funding fee, which is a fee that gets charged up front on VA loans that basically takes the place of the mortgage insurance. So it's a single premium that some pay. Mortgage loan terms can be anywhere from 30 years down to about 10 or 15 years. The most popular terms are the 30-year and the 15, but they go in 5-year increments. So it goes 30, 25, 20, 15, 10. The longer the term, the less your payment is, because you're spreading those payments out over a longer period of time. If you get a 15-year term, your payments might be higher, but you have a huge savings in the interest that you pay. So what determines mortgage eligibility? There's 4 things that underwriting looks at to be able to determine if you're eligible for a mortgage. They look at capacity to pay back the loan. They look at the capital. They look at the collateral. And they look at credit. So let's take a closer look at each of those. So the 4 C's of underwriting capacity. So capacity, again, is the ability to be able to pay back the loan. Do you have steady income? Have you had consistent employment? Have you been able to set any money aside? Do you spend above your means? Meaning, do you live on credit cards? People do. Capacity. And the next one is capital. Okay? Are you financially healthy? Have you been able to set money aside? Do you have any reserves? Are you saving for retirement? And do you have a long-term financial goal?
I have a question, Nate. When you said financially healthy, what do you mean by that? Because I think that talking about healthiness in finances is kind of very special.
Sure. So in terms of mortgage lending, financially healthy just means that you do have steady income, that you do have more than you're planning to set down. So in other words, if you're putting 20% down on a $200,000 house, that 20% down payment is going to represent more or less than you actually have in the bank. So after you put that 20% down and pay closing costs, are we depleting your assets, or have you got some left over? That is having a healthy financial picture. Does that make sense?
Yep.
You might notice a theme as we go through this, but I really like the movie Jerry Maguire. Sorry. Collateral. So collateral is going to be the home itself, because that is what the lenders will be buying, right? They're paying for the mortgage. Now they're going to invest their money in the mortgage if it's a good piece of collateral. Does it have curb appeal? Is the home well kept? Are there any structural concerns, any home damage? Is the home comparable to other homes in the neighborhood? So you're going to see that most of the time you're not going to have houses that are under 1,000 square feet and then suddenly this little mini mansion next door to it. Because the builders know that they put their home there, they're automatically going to lose appreciation. It also makes it a little bit weird in the neighborhood. It's going to stick out like a sore thumb. If you've got under 1,000 square foot houses and then suddenly this, 2-story, 2,500 square foot home, it just looks strange. And finally, credit. So credit is a thing that we're going to dive into here in just a moment that a lot of people have questions about. There's a lot of confusion, there's a lot of misinformation about credit, and really it's not that complicated. But in terms of underwriting, credits, are you responsible with your payments? Are you overutilizing your revolving accounts? And a revolving account is a credit card or a charge card. So if you've got a Capital One card, a Visa, a MasterCard, etc., if you have access to balances on those or credit limits on those that you're not using, then that's good. We want your credit utilization to be under 30%. So that means for every $1,000 that you have available to spend, that you're spending no more than $300, or you're carrying balances of no more than $300. Speaking of credit, some people are familiar with Credit Karma, Credit.com, CreditWise. They check their credit scores. The scores that you see in those apps most likely are what we call consumer credit. That's the credit score that you would have a bank look at to give you a credit card, or a store, a department store would look at that score to give you a credit card. But the most recognized credit score is the FICO score, which is the Fair Isaac and Company, and there's actually 50 different scoring methodologies for that, depending what you're buying, where you're buying it from. So when you go buy a vehicle from a dealership, they're going to pull your score. It's going to be a different score because they are using the auto score. When you go get a home loan, we are using a mortgage score. So those things are not always going to translate. You'll find that sometimes your mortgage score could be considerably higher or even considerably lower than your consumer credit score. So if you have any questions about credit, it's best to check in with your mortgage advisor so that we can walk you through what those differences are and the different weights that are applied to the different types of accounts. The anatomy of a mortgage payment. This is literally the monthly mortgage payment formula, where the paying variables are paying. P equals the monthly payment, A is the amount borrowed, I is the interest rate, and the N is the number of payments. So anytime I sit down to do a mortgage, this is the formula that I use. Not really. I mean, this is really the formula, but we live in the 21st century where we have calculators that do this for us. Thank God, because algebra was not my strong suit. I'll just say that now. So the mortgage is constructed of a couple of different things. P-I-T-I-A. You might hear people refer to it as a PITI payment, P-I-T-I. That's principal, interest, taxes, and insurance. And lately what's been added to the end of it is the A, which is the association dues. So the principal is the amount that you borrowed using the formula to try to determine what your principal payment is, amortized over 30 years or over 15 years, depending on the length of your mortgage. The interest is the interest that you pay each month based on the credit score that you got and the interest rate that you were given. Okay? Taxes and insurance, that's going to be your real estate taxes, depending where you live, and your homeowner's insurance, depending where you live. Those things fluctuate. Taxes are going to vary depending on the part of neighborhood that you're in, the part of town that you live in, if you're in a subdivision or a planned urban development or not. Those things fluctuate. Insurance is the same way. Depending on where your home is located, there might be a higher risk for you to be insured. So your insurance might be slightly more expensive. Those are things that can be addressed by going to the Brevard County Property Appraiser's website to identify where you live and what your assessed value is for taxes. And then, of course, contacting a licensed home insurance agent. Association dues. So association dues are pretty much going to be a part of life if you live in a condo, because there's a condo association. And if you live in a subdivision or a planned urban development, chances are that there's some sort of homeowners association and you've got to pay them dues, whether it be monthly, quarterly, or annually. water somewhere? All right. And then PMI, I addressed PMI a little bit ago, but again, PMI is going to be an insurance policy that you literally are required to take out if you put less than 20% down. And it's an insurance policy that covers the lender in the event that you default. If you don't have the means to put 20% down, you're a higher risk. Doesn't mean that you're a bad person, it just means you're a higher risk. So we have an insurance policy in the event that you're not able to continue to make the payments. So pre-approval and pre-qualification. This is one that trips up a lot of people. Is there a difference? Yes, there is. What's the difference? I'll tell you. If you are pre-approved, excuse me. If you are pre-approved, that means that you have had your income verified, your assets verified, your credit's been verified, and we've put your loan through what's called an automated underwriting system, which complies with the Fannie Mae and Freddie Mac that we talked about earlier, their guidelines, so that we know, based on what you verified with us, everything should go pretty smoothly and you should be approved because you've been pre-vetted. A pre-qualification literally means that you've told me your income, you've told me your assets, and you've told me your credit score. And based on what you've told me, I'll tell you that you're pre-qualified. I don't write a pre-qualification letter though, because it's really not a good means of being able to help a real estate agent or you determine what your price range is, or if you'll even be qualified at all. So I only do pre-approvals. So how do I get started? If I wanted to buy a house right now, what's my first step? Getting pre-approved. It's important that we verify your income, your assets. When you have a pre-approval letter, that you can make a strong offer. So when the Nate Joom team verifies your income, your assets, and your credit, it gives you the strength and the confidence of a cash buyer. Now that's not literally a cash buyer because you're financing, but you've been vetted. So what are the components of a pre-approval? First of all, we verify your income. We verify your assets. We review your credit, and we discuss loan programs. Once we've gone through that, we will structure your loan, which just means that we'll take all of the things that we've discussed and we'll look at the different loan programs and we'll try to identify which one makes the most sense for you. We'll map out the payment model. We'll run the loan through AUS, which is automated underwriting system. As I spoke to a moment ago, that's an automated underwriting engine that will tell us if Fannie Mae and Freddie Mac will buy that loan from us. And then we review the findings from the AUS and we issue the pre-approval. So I'm pre-approved, now what? Now you take your pre-approval letter and I can introduce you to any of the real estate agents that I work with in Brevard County, throughout Florida, throughout Georgia, that will be able to help you. They will go to bat for you at that point. They'll negotiate the paperwork for you. They'll fight to get you the best price available. And then once you've gotten a contract, you'll come back to the Nate Joom mortgage team and we will start working on your loan. So I want to be your resource for mortgage questions, for scenarios. If anything comes up and you have a question,